Aspect of transfer pricing. Today we have two speakers, CA Umesh Agarwal, Mr. Deven Shah. They will deal with the cost plus and profit split method. Deven will deal with the theoretical part and Umesh will deal with the practical part. He will, what I discuss with him, we'll be covering two case studies in the CPM method, two case studies in profit split method, three case law in the CPM method and two case law in the profit split method. With the further proceeding, I request Deven to take up the charge.
Friends, I have the pleasant task of introducing two speakers of today. One is Umesh Agarwal. He is a chartered accountant practicing with BDO and is specializing in transfer pricing. And Deven Shah is a tax consultant practicing direct taxes. Without taking much of your time, I request them to start the proceedings.
I also welcome you. I'm dealing with cost plus method, profit split method, and with theoretical part. The practical part will be dealt with my colleague, Mr. Umesh. The cost plus method, actually CPM is the arm's length price as CPM minus direct, so equal direct cost plus indirect cost plus adjusted GP margin. According to 10B1C, knows the following: direct indirect cost incurred by the enterprise is for property transferred or services provided to AE. With that, you will add a normal gross profit markup. This will be the GP transfer similar property or services by the enterprise in a comparable uncontrolled transactions, internal comparable, or GP on transfer similar property by unrelated enterprise in a comparable uncontrolled transaction or remote such transactions, which means external uncomparable. The normal GP markup in about two should be adjusted for functional other differences between the international transaction and comparable or between the enterprises involved in both the transactions. Adjustment should be made only such differences materially affect GP margin open market, that is free open market. After making adjustments to C, we get what is known as ALP. Now, coming to UNDP manual, defines cost plus method as begins with cost incurred by the supplier of services in a controlled transaction for property transferred or services in a controlled services related to related purchaser in related enterprise. Cost plus markup is then added to this cost. Make an appropriate GP in light of the functions, light of FAR, that is functions performed. Is resume assessments in market conditions. On the manual, the control transaction involving tangible property, the CPM focuses on the related manufacturing company as a tested party in the transaction. This can also be used in case of services rendered. CPM, now it is dealing with ES application. Used for transfer pricing issues involving tangible property or services. Also, typically applied to manufacturing, assembling activities, and simple service providers. Focuses on the related party manufacturer or service provider as a tested party in the TP analysis. It evaluates the arm's length nature of an intercompany transaction charged by reference to gross profit markup on costs incurred by suppliers of property or services for tangible property transferred or services provided. It compares the gross profit markup earned by the tested party for manufacturing product or providing services to the gross profit markups earned by comparable company. Figure one cost plus method. Cost of E1 is $500, E1 to E2 plus gross profit markup is 50%, $250, ALP is $750. Like the RPM, the CPM is a gross margin method. It attempts to design ALP, amount of gross profit, In this case, arm's length markup on cost of goods sold. E1 electrical manufacturing E1 manufactures on the counter for E2. E2 instructs associated intervals 1 in the conjugating quality, that is based E2 can manufacture only on the E1 can only manufacture on the instructions of the E1. E1 will guarantee sales to E2 and face retail risks. There is not much risks. E1 is less complex in terms of functions and risks than E2. The analysis and backup method will focus on E1 as a tested party. Since E1 is a simple manufacturer, the CBM may be the best method for analysis in this case. Then analyzes whether gross profit markup earned by E1 is at arm's length by reference to the gross profit margins earned by companies manufacturing comparable goods for providing comparable services to unrelated parties. CPM does not directly test whether the transfer price is at arm's length by comparing prices. Such is a less direct transaction method as compared to CPM. Where cost means actual cost and estimated cost. You cannot take any estimates. You have to be actual. Reliance Industries Solution CID. It was held that actuals only taken the correct cost, only then cost plus money can be applied. It does not contribute estimation cost. UNDP manual expenses mechanism is under CBM and applied to sales of tangible property. Arm's length price equals the control party's cost of producing the tangible property plus an appropriate GPM. Gross profit markup, defined as the ratio of gross profit to cost of goods sold, saving operating expenses for comparable multiple transaction. The formula for the transfer price intercompany transactions is as follows. DP is equal to CGS cost of goods sold into 1 plus cost markup. Cost plus markup, sorry. The DP equal to transfer price of products sold between manufacturing company and related company. COGS equal to cost of goods sold. The manufacturing company, and cost plus markup is gross profit markup defined as the ratio of gross profit to the cost of goods sold. Gross profit defined as sales minus cost of goods sold. Example, using the cost of goods sold the above side is $500. This assume also that the ASB gross profit markup that associated enterprise once one is 50%. The resulting TP will be between A1 and A2 is $750. That is $500 plus into 1 plus 0.50. Arm's length gross profit markup for cost plus money. Actually, for offers following value regards gross profit markup for CBM. Relation also considers CBM is gross profit markup minus gross profit markup. Gross profit markup is cost of goods sold ratio of manufacturing company. GP equal net sales minus COGS. Manufacturing company cost of goods sold equals the cost of producing the goods sold. It is direct labor cost, direct material cost factory overheads associated with production. This is RP and accounting consistency is extremely important in applying CPM. We will not apply different accounting principles. The accounting principles will be consistent. Appropriate adjustment accounting principles may be necessary to ensure gross profit markup are calculated uniformly for tested party and the comparable companies. For example, comparable manufacturers may differ from related party manufacturer in reporting certain costs, the cost of R&D as operating expenses or the cost of goods sold. Differences in revenue valuation also affect the computation gross profit markup. Cost expenses of a company will normally fall into three different groups. This is direct cost of producing product or service. This is cost of raw materials. Indirect cost of production, example, cost of repairs, services equipment used to manufacture different products, and the operating expenses, SG&A expenses. Gross profit margin used in the CPM is profit margin that is calculated by subtracting only the direct and indirect cost of production from the sale price. In contrast, margin analysis will also consider operating expenses. Due to differences in the accounting standard, there is Indian GAAP, US GAAP, and IFRS. three countries. The boundaries between three groups of cost expenses not same in each and every case. Suitable adjustments need to be made. In this situation, it is necessary to consider such operating expenses to obtain consistency and comparability. Net margin method is usually more reliable than the CPM.
Deven, I suggest we skip the example because he's taken up some case studies.
Okay.
So we go on to direct comparison and go to the law because he's taken up case studies as well as examples and case laws. So we'll skip that part. We'll look at the law part and then also let him take up the case studies. And if something still remains unaddressed, then we'll take it up.
Okay.
So I think we finished the other parts that we have. So comparability part. And when to use CPM, strength, weakness.
Okay, we go straight to comparability part. Okay. And next is comparison versus functional comparison. And next is comparison functional comparison. The gross profit markup earned by the statement. By the related party manufacturer selling goods will be introduced in a comparable control transaction, which is reversibly rejected as internal comparable for purposes of applying the CUP method because, for example, involves a different models of bicycle. For example, the control transaction involves the manufacturing recreational bicycles, but the unrelated transactions involve on-bicycle rexos, etc. This will involve broadly similar products with comparable accounting measures of cost of goods sold, making margin comparison sufficiently reliable. Then in functional comparison, the gross profit markups earned by independent companies performing functions incurring risks comparable to functions performed risks incurred by related party manufacturers. Functional comparison involves search for comparable manufacturing companies.
Can anyone just point out what is transactional comparison and what is functional comparison? Let's take some examples.
Thereby the product becomes indifferent. So that's why if you distribute your distributor.
Come ahead, please come ahead because if you can come here then it will be.
But if you're comparing, say, a distributor, comparing a wholesale level distributor with another wholesale level distributor would be a functional comparability. I mean, you cannot compare a wholesale versus a retail distributor.
Then I suggest you come over here only. You come over here only.
Pardon?
Over here, opposite. Because you are actually probably the most experienced.
This learning it.
The most bottom of the learning come.
Yeah, so I think what she mentioned is correct. Just to take it further, when we do a transaction to transaction comparing, that is what we call it as transactional comparable. And when we overall look at functions, assets and risks and with respect to a particular transaction and do a comparison, that will be more a functional comparison. Now typically transactional comparison is more a direct comparison of a particular transaction, whereas functional comparable you tend to eliminate some basic differences and do more of a generalized comparison. For products it is very easy to do transactional comparison, but it may at the same time be challenging for services. So in services we generally look at a functional comparable. Please.
For example, there are two distributors, right? There are two distributors. One distributor of tractors and other distributor of cars, right?
Right.
Now, on a functional comparability, both are performing the same functions as that of a distributor. But on a transactional comparability, they don't fit into that comparability partition. So in that case, can we benchmark the margin of the distributor for tractor vis-a-vis the distributor?
Okay. Now just to take your point a little further, is when we are doing a transactional comparison, we look at transaction A and transaction B. How are the two transactions similar or different? when I'm saying that I'm a distributor and I'm earning a commission markup on both the points, but the products are different, their markets are different, the efforts required are different, the specialization that may be required is different. So then it boils down to functional comparability. So when we say functional comparability, is it that I am as a distributor performing the same functions? Maybe to some extent, yes. But when it comes to assets and risks, will my assets be identical? Maybe to a certain extent, yes. But risk profile again would be different industry to industry. So the first level of comparability, if you say like to like, it may be challenging. But then you go to next level. I mean, first, if you are able to identify the best comparables, more identical comparables by first approach, that is the ideal. But then, when you are unable to conclude your comparability based on your first search, you dilute your search a little bit, maybe discount the risks or make adjustments towards the risk to the extent possible, and scale down the comparability to look at much broader range. So maybe, when you say comparability of what examples did you do?
Tractors and cars.
Okay, so tractors is something which is more of an agricultural equipment or maybe a vehicle. So maybe if I look at comparable between distributor of other agricultural equipments, say pumps or something similar, maybe that will be more nearer compared to a distributor of car, which is more of, again, within car also, do you say that distributor of Maruti products and distributor of BMW products, are they same? I mean, we know the differences ourselves. You look at their showrooms, you look at their advertisement expenditure, you look at their advertisement efforts, look at the segment that they cater to, look at the margins that they earn, they'll be completely different. So maybe, we would come to that level of comparison by exhausting each level that, okay, at this level, I'm not getting any better fit comparables, so let me dilute it a little bit. And then that's how we scale down. So that's the approach one would need to take. Even at looking at, when we say transactional comparable, the determination of or the degree of comparability is far higher. The requirement of degree of comparability is far higher. Natubai, please point me out wherever. I'm here to learn. Also, we learn from.
Is also there.
Please.
Comparability. According to the UNDP manual, uncontrolled transactions considered comparable to a controlled transaction applying the CPM if there are no material differences.
Just one moment. Before we move ahead, how many people or can we list down the sources of our learning? I mean, what all should we look at when we learn transfer pricing as a subject? We look at definitely Indian regulations. We look at that is the Act, the rules. We look at the Indian case laws. We look at the Indian commentaries. But apart from that, what are the other guidances that one should look at?
OECD, UNDP.
Right. So OECD guidelines, the UN transfer pricing guidelines. There is also Asia Pacific, I think, tax practitioners manual on transfer pricing. There is something called the ATO, Australian Tax Office. They have some wonderful and simple transfer pricing guidelines which are very easy to follow, done with good examples. So what I would say is, each one of you, when you try and learn transfer pricing or understand and read about transfer pricing, do not restrict yourself to reading about only Indian transfer pricing, although Indian transfer pricing is a subject that we are studying. But transfer pricing is very global, and if you see, our guidelines are also based on OECD guidelines recommendations. So whatever is happening globally in transfer pricing, it has more effect. However, that may not be equally true when we learn about Indian Income Tax Act, because the provisions are codified in a very special manner. Whereas transfer pricing is more of a generalized subject which has been legislated in some particular sections. Whereas lot of it goes behind the legislation. The comparability, the computations, the risk analysis, all those things. So do not restrict yourself to reading only the guidance provided on the Indian law, but do also read, make some reading of the international laws, what happens in US service regulations. Those are also some very good guides to service transactions. So do not restrict yourself. I think rightly Deven has covered UNTP manual. He's also covered OECD corners on this subject. I think, just wanted to bring that these are the subjects or these are the sources that we should look upon.
Just one point to add here, we have a very good book for the transfer pricing digest. It's by Manovi Dalal, if I'm not wrong. It looks pretty much like the Act, it's white and maroon. And it's got all the Indian TP cases, categorized as per the subject. So the top member has a list of it. It's very easy if you're making your, submissions to the TP office or something.
Just to add, even the Chamber's publication on transfer pricing, which is, I think, almost released, we are expecting the commercial copies to be available.
Booking has started, sir.
Okay, booking has started.
Transfer publication from Chambers.
So that is a digest of almost 60 articles, from basic to in-depth, where we have analysis of specific industry-related issues also covered. I think if you can all refer to the page number 9 of the Chamber's newsletter.
According to the UNDP manual, uncontrolled transactions considered comparable to a controlled transaction applying the CPM if there are no material differences between the transactions. That is just, minor differences, not significant or material as we know in accounting. The similarly accurate adjustments can be performed just from effects of such differences. Those similarity products in uncontrolled transactions less important under cost-plus method than under the cup method. While functional comparability, including comparability of risk regime and assets use, is more important. However, because significant differences in products may necessarily result in functions, the control and control transactions to ideally involve the manufacturing products within the same product family. As a GP markup remunerates a manufacturing company for performing a manufacturing function, CPM necessarily requires functional comparability. If the material differences functions performed affect the gross profit, markups actual control transactions, adjustments we make to account for such differences. The general comparability adjustments we made in the gross profit markups of the uncontrolled transactions. Sometimes operating expenses in connection with the functions performed and risks incurred will be taken into account as differences in functions performed may be reflected in operating expenses. Determination cost. According to the UN manual, application of CPM entails remote potential difficulties associated with the determination of cost as under. It's important to apply comparable markup to comparable cost basis. Differences between tested party comparables should be identified. Careful considerations relate to what cost should be excluded from the cost basis. An example of costs as excluded are particular costs that are passed through, that is, costs are explicitly not subject to a markup, both the tested party comparable transactions. The accounting consistency is extremely important. Gross profit markups should be calculated uniformly by the associated enterprise and the independent enterprises. Historical cost will principle be ascribed to individual use of production. If cost refer to a period, average cost over the period may be used. Cost considered using CPM means those of the manufacturer of the goods or the service provider. Problem may arise with respect to the allocation of some cost between manufacturer or service provider and the purchaser of goods or services. Strengths and weaknesses. According to the UNDP manual, since the CPM result is based on internal cost, the information is usually available to the multinational enterprise. According to UNDP manual, the weaknesses of CPM include the following. There may be a link between the level cost and market price. The markup gross margins may not be comparable due to accounting inconsistencies and other factors. Accounting consistency required between control and control transactions. That is, I think, most around our actual consistency principle. Analysis focuses on the related party manufacturer, and since matter is based on actual cost, there will be no incentive for control manufacturer to control cost. And use the CPM. UNDP manual gives the following guidance. One second. Sorry. Typically applied in cases where intercompany sold tangible property, the related party manufacturer performs limited manufacturing functions. In case of intergroup provision of services, the matter usually assumes the incomes over risks because the overall cost will then better reflect the value being added as a market price. The CPM also generally used in transactions involving a contract manufacturer, tool manufacturer, low-risk assembler which does not use the product intangibles because which are risks. Related custom involving control transaction will generally be much more complex than contract manufacturer in terms of functions performed. Example, conducting marketing and selling functions, coordination of production sales, giving instructions to the contract manufacturer for the quantity and quality of production, processing raw materials in some cases. Risks incurred the market risks, credit risks, inventory risks, as well as own product intangibles. Contract manufacturer is thus the less complex and thus serves to be the tested party TP analysis. Now we come to the OECD used in CPM. OECD recognizes external CPM as under. CPM begins with the cost incurred by the supplier of property or services in control transaction for property transfer the services provided to an associated processor. Appropriate CPM is then used to this cost to make the appropriate profit in light of the functions performed in the market conditions. How this variety of the adding cost plus markup to the above cost may be regarded as an ALP of the original control transactions. Now CPM versus RPM. CPM starts with computing cost of providing goods or services and has appropriate markup. In contrast, RPM starts from final selling price and subtracts an appropriate cost margin over the purchase price. CPM versus CMM. CPM means margins computed after the indirect cost of production, while the net margin method will use margins computed after operating expenses of the enterprise as well. So I am just giving you this judicial decisions because this will be dealt with in detail by my colleague. Ashtek Software and Technology Services Limited was Assistant CID 2007 ITV 141 Bangalore Terminal. Weekly India Private Limited Revision CID 2011 48 SOD 53 unreported.
It's okay, I think everybody has the copy, so we can move to Umesh. I think if you can take up case studies after this, sure, or the case laws on the cost plus method, then we can move to CPM, CPM of its previous.
So the facts of the first case study are like this. So
the case study, let's keep it interactive. Put your questions, your suggestions, what you feel about the subject, what you feel should be the way it should be best dealt with, and then let's look at the paper writer's views also on this. You think that is more appropriate?
Sure, I think. So, X Limited is an Indian company which is engaged in the manufacture and supply of tablet tools used by the pharmaceutical industry. Now, these tablet tools manufactured by X Limited are sold to its AEs located in various countries, and these AEs are primarily engaged in the distribution of such tablet tools in their respective countries. Now, the question here is, can CPM be adopted to benchmark the sales made by the Indian company X Limited to its overseas AEs?
I think this again brings us back to the question is, in what situations or scenarios do we apply CPM? Comparability. Okay.
I think in this case we also need to see as to what are the functions and the risks that are undertaken by X Limited. In my opinion, I think that
correct. In fact, we also need to look at the functions, assets and risks of the AEs.
Correct.
Because if they are also performing significant functions apart from if X Limited does manufacturing, but a lot of value is added in terms of intangibles by the AEs, then probably CPM may not be appropriate.
Correct. So for benchmarking, we need to see who should be considered as a tested party. So the tested party will be the party who performs the least complex functions and data for which is reliably available. Now in this case, if you see the AEs are located in various countries, So if A's are considered to be performing less complex functions than X limited, you really would need to benchmark or take those A's located in various jurisdictions as a tested party, which may not be possible because data for such companies may not be available. So in such a case, if you consider X limited as a tested party, then considering that it is in the manufacturing business, so CPM could be adopted as the most appropriate method in this case. This was scenario 1 of the same case study. Now in the second scenario, the primary facts being the same. Now suppose X Limited also purchases some components required for the manufacturing from its domestic associate enterprise AE1. Now whether in such scenario, whether CPM can still be adopted to benchmark the sales made by the Indian company to its foreign A's.
Over here,
you are benchmarking two transactions.
So, in fact, what Umesh is questioning is for its sales part, can you use CPM? Interesting case study. What are the principles, or what are the principles of applying CPM? What do we do while we apply CPM?
Basically, what she's trying to say is that the X Limited has to do some value addition to the good to make sure that the manufacturing comes under the umbrella of manufacturing. So, only there, I think that's what we're trying to say, right?
I think which it does. So, X Limited manufactures the machinery, only some components of the machinery are procured from the local associate enterprise.
So, in my view, it can be applied on the transaction of the sale to the A's, but we'll have to benchmark the purchase transaction as well.
Correct. No, so the question is, can CPM be adopted for the sale transaction?
I think it can. That's my view.
So we have a decision called Tara Ultimo, which I will discuss later on. So wherein again in that case it was a diamond jewelry manufacturer basically. So it used to purchase diamonds from its A's and used to do some processing and sell jewelry to its associate enterprises again. So in that case, the tribunal said that unless and until the import transaction is not held to be at arm's length, and in that case the taxpayer could not justify those transactions at arm's length. So in that case, the tribunal held that then you cannot use CPM because your cost side is also tainted. So you cannot use that. But having said that, there are other contradicting decisions in the case of MSS, where again the purchase side transaction included some 8 purchases, but the tribunal still held that CPM could still be adopted in those cases. We also have a High Court decision in case of L'Oreal, wherein the transaction in fact was just of a purchase transaction from a AE. But even in that case, the High Court has upheld application of CPM.
So we have more favorable decisions for application
correct.
of CPM.
And even if you see the regulations doesn't really talk about that the costs should be untainted costs. It just says you have to add up the direct and the indirect cost of production. It really doesn't talk about the tainted transactions.
I think Umesh, maybe what you're saying may be true that the regulations do not prescribe. But again, the question always arises when you are comparing a transaction which is based on some other transaction. That other transaction would definitely have some implication on your main transaction.
Right.
So can you really look at, say for example, if my purchase transaction is not benchmarked or it is not found to be at arm's length, then would it not affect my sales price or my margin on my sales price? It would. So I mean, while the regulation doesn't stop you from using the related party transaction also, at the same time I think the first decision you mentioned was
Tara Ultimo.
That really lays down the stress that once you benchmark the purchase transaction and that is found to be at arm's length, then it would be fair to also use CPM to benchmark the sales transaction.
Sure.
But the question here is, in the first decision which you said was unfavorable,
Correct.
when they said it was stated, what did they use then? So what, in that case you have to still benchmark the transaction.
Yeah, so in that case TMM was used.
While we all are discussing,
I'll discuss it in detail later on.
while we are all discussing cost plus method, how many of you have practically applied cost plus method while doing some kind of study or assessment or some appeal? Okay, so the challenge most of the times in cost plus is getting the gross margins. Unfortunately so, but the way the Indian GAAP has been designed doesn't give you a clear answer of cost plus. Most of the times whenever you use cost plus, you end up making certain assumptions about the financials. Unless you are using cost plus in a pure manufacturer condition, where all your direct costs are automatically captured in your cost of goods sold. So what you get basically sales minus COGS is pure gross profit in the normal parlance. So when you maybe for your profit derivation, it is simpler for you to derive gross profits. But how do you derive gross profits from comparables? So that has been the challenge most of the times. But lot of times you look deeper into the financials. You look at the notes to accounts to try and find out if there are adjustments to that, schedules and sub-schedules. And the key in applying cost plus method or resale price method where you benchmark gross profits is the uniformity you adopt to compute gross profits. That has to be uniform across.
Correct. In fact, I'll just take that up just after this slide. So now the sales side transaction could be benchmarked using CPM. Now how would you then benchmark the transaction of the purchase of components from the domestic AE? So which method, considering that the domestic AE manufactures these raw materials exclusively for X Limited, and there is no real cup available in this transaction.
So AE1 is a manufacturer.
Yeah.
So cup is out, RPM is out. So either use a CPM or you go with the
Sure. So exactly. So now that now between X Limited and AE1, now because X Limited manufactures and distributes these machineries, whereas AE1 is really more like a contract manufacturer for X Limited. So you could consider AE1 as a tested party here because it is less complex. So taking AE1 as a tested party, and because AE1 is a manufacturer, you could again adopt CPM for benchmarking this transaction as well, taking AE1 as a tested party. So now how do you really determine the ALP? Now, as the regulations are, first you really identify the direct and the indirect costs of production, and then you gross that up with the nominal gross profit margin earned by comparable companies. So after adding the total direct and indirect cost of production incurred for the A transactions, and after you gross it up with the markup, that will be your ALP. Now this is as per how regulations prescribe it to be. Now practically what is being done is that taxpayers calculate their gross margins from the transactions with their A's, and that they compare with the gross margins earned either with the transactions with non-A's or what is earned by comparable companies. Now practically this is being done. In some cases this approach has been accepted, but again in case of Tara Ultimo, they have rejected this approach, to which I will come to later. So any comments? Yes.
So indirect cost of production is typically from a P&L. Because direct cost will be coming up in your trading account.
No, so indirect cost of production, so that direct cost would generally be your purchases of raw materials and finished goods, and indirect cost would be more of your overheads and everything.
Basically applies in the P&L.
Yeah.
I'm just confirming my understanding. I'm not
See, indirect cost, but you'll get it more from your accounts actually, rather than from the P&L, because in the P&L, suppose if you consider electricity charges, so that could be both your factory overheads as well as your admin overheads. So really, just from on the face of the P&L, you might not be able to calculate the gross margins.
In fact, on that point, there are various aspects that one would need to look at. And the answer to your question is the most scientific way of doing allocation. There are various aspects to it. Let's take for example rent. How do you allocate rent? Is turnover the right basis? It's the space which is being utilized. So you have to look at each cost and determine what is the most appropriate method to allocate these costs.
What I suggest, our departmental accounts that we had in college and CA, I think that will some more help us. Departmental accounts that we learned in CA earlier BCom, that I think might help us, because there also we were portioning it on the basis.
Okay, so yes, segmental, while you prepare segmental, you do those allocations.
So here I have just given a screenshot of progress. So wherein really what factors or what items you could consider for calculating the gross margin of a comparable company. So herein for those who use progress, so once you go to report viewer, you have this income and expenditure summary. So under the expense, what you could consider for direct costs could be direct and indirect cost of production, could be again the raw materials and stores and spares purchase of finished goods, packaging expenses, power and fuel, excise duty considering it is really an indirect tax on the manufacturing activity, and also some, if there are some outsourced manufacturing jobs, which again would be a direct cost for that manufacturer. So these are some items which you could look at, take into consideration for calculating the direct cost, provided the financials are not available. So in case the financials are available, I think the best approach would be to look at the financials and identify the direct cost from those financials. But
for example, excise duty, if you do an inclusive approach, it is generally included in your purchase cost and married to your the closing stock also, it is inclusive. But if you value or if you use exclusive basis, then probably you may also see it as a separate line item where you need to probably adjust. So looking at the financials, the accounting policies and principles, all those also, when you select a comparable, make sure that you look at also the accounting policies. If there are differences in policies, your result may change.
So here, under just coming back to the same thing.
Sure.
Under indirect costs, you will take the rent and electricity in the proportion of the goods, the direct cost to the factory, right?
correct, for the manufacturing costs.
The proportion
Yeah. There is just some problem with the slides, just give me a minute. Yeah, so the second case study is an Indian company, A Limited, who is engaged in rendering of information technology consulting services. Now, in year 1, A Limited had rendered these consulting services to both its A's and its non-A's, and in this case, the taxpayer had employed separate set of employees for rendering these services to A's and non-A's. Now, again in this case, can CPM be applied? Considering that separate employees are identified for each segment, and so the direct cost really for rendering these services is available. So then in this scenario, can CPM be adopted?
No views? Again we go back to the same question. What are the prime tests that you look at while you apply CPM? Who is the tested party? Whose functions are simpler? Is the data easily available?
In case of service industry, don't you think that direct and indirect cost of providing services will almost be, I mean, whether you benchmark it at net margin level?
Correct.
Gross margin, because the direct and indirect cost can be other costs.
Right. In fact, that is one of the primary reasons why CPM is generally rejected for the service industry. But consider a situation where you really have losses at the entity level, and ideally CPM is ideally the most appropriate method to benchmark a service transaction, a person who is rendering services. But generally people reject it, saying that direct costs is not available. But to get out of a situation where you have losses at the entity level, so you need to benchmark the transaction using some method, and suppose even CUP is not available and CPM, you really left with CPM, and this is again a scenario where the other method is not available, supposing. So then ideally some analysis where you could demonstrate a transaction at arm's length. So you could look at CPM wherein the direct cost for rendering the service is really your employee cost and related overheads for providing that service. So you could consider it as your cost for rendering the services, and then accordingly you could use CPM.
So strictly speaking, again, as you said, in service industry it is very difficult to apply cost plus. When we say cost plus, it is probably identical to net margin method, because a lot of your indirect costs are also based on your direct resource costs. So they move in tandem with the direct costs, and that is why generally it is net margin which is more considered in service industries.
Right. So this was the case in year 1. In year 2, the A Limited did not render any services to non-A. So basically there was just services rendered to its A only. So in this case, because internal comparables are not available, again you could look at using an external CPM and benchmark the gross margins with gross margins earned by comparable companies rendering similar services as that by A Limited. Again, this case study is based on the assumption that really CUP is not available for the transaction.
So just to answer your question, let's take a chartered accountant service. How many of us disclose our billable rates to the clients? I mean, very few of us do work on hourly rates. So most of us work on a fixed fee contract. So let's say, for example, non-AE is a fixed fee contract and AE is on a cost plus markup kind of situation. Whatever is cost plus, say 20% or 25% is paid to. How do you really compare those then? Is your internal data to demonstrate your cost sufficient for the income tax officer to derive what were the number of hours, what was the actual billing rate per hour vis-a-vis the billing rate per hour in the non-A business? So, these are the challenges that you will face while using CUP. So, definitely if both of them are quoted, per hour rates, then it is a direct CUP which could, certainly be used unless there is a significant service difference in both the cases, or resource difference or cost difference in both cases. Again, your second question where you said that in the second year, can we use the first year's non-A transactions to benchmark? Does anybody have any suggestions on that? Can we use it?
I don't think that's possible.
Anyone?
It's just that in this year, I don't have a business from my third party. Next year, again, in year 3 or year 4, I will have it. So I'm saying that, in this case, where I'm providing a consultancy services. My consultancy services can be as well as non-A so like in 1 year if I don't have a third party to do whatever reasons, I not use the same rate where my rate remains the same.
I think the regulations require to use contemporaneous data So ideally the department would look at whether if you have transactions in the same year itself, and considering that scenario, then you really select your most appropriate method. Is what I feel.
Just to now take the situation, the same situation. For example, year 1 was Congress government, year 2 was BJP government. I'm just, now this is a political scenario difference. Maybe there is economy which plays a role. Maybe the margins, maybe your prices have remained same, but the comparables did better in year 2. The outside comparables, they did better in year 2, and you did not charge better. So there are various factors apart from just your own transaction, and the reason why contemporaneous data is required primarily to equate yourself with your comparables, or what would be the arm's length situation. This year you did not have, now this is something which I give an extreme example, but you look at simple items like if you look at mineral industry, where prices move across seasons. So what happens in those cases? Within a year also, if you are having a transaction with AE and non-AE, you may not be even able to compare those for timing differences. So timing is one very important factor, but to set a simple answer to your regulations, your question is no, you cannot use those comparables because they do not pertain to the current year, and you would be compelled to move to another method. If no method gives you a particular result, or you are not able to get comparables for any of the methods, maybe as a reference point you could use those transactions, but those are not in sync with the regulations.
Again, regarding the hourly rates, I think what the department contends, and in my opinion rightly so, is that ultimately what your profits get affected by is the actual billing that you do, and in an hourly rate it is a factor of the actual time you spend. And generally in the service industry, the billing is as per what estimate you do. So you quote a lump sum fee based on the estimated time that you expect to spend on that project. So you could very well manipulate the hours that you spend on the project, which could affect the profitability of the transaction. And there are, I think, contradicting decisions which go in either favors. There are decisions which have upheld comparison of hourly rates, and I think there are decisions which have rejected the comparison of hourly rates.
I think it really depends on how strong documentation you have, and what kind of data, what quality of data that you have. If you have sufficient data to demonstrate that both are equal, comparable, both are not compromised, and everything could be tested, nobody can stop you for using comparable hourly rates.
One more, how that comes into my mind is that in case of cost plus, when we say that we are benchmarking our transactions on cost plus, so in that case, do we need to see the conduct of the parties in that invoicing, whether that has actually been done at cost plus or the sales price has been determined on some other basis? Because to my mind, what comes is that when you are working on a contract basis or some, whether in a manufacturing sector or a service sector, a contractor can never be at loss, because what is remunerated is at cost plus. So is that important to see?
There are two concepts. I mean, generally I see people probably mixing these two concepts. One is the concept of pricing your transactions. When we speak of cost plus, a contractor being on cost plus, this is a mechanism to price your transaction, that whatever cost he incurs, he marks it over and bills it to you. So this is a pricing mechanism, and here when we talk, this is a benchmarking or a method to determine ALP. So these are probably connected but two different things. So what we talk of that in software industry it is cost plus 20%, it's not applicable. We are not applying CPM to demonstrate your arm's length nature. You generally end up applying TNMM. So pricing your transaction using cost plus, nobody can stop you. You can price your transaction the way you want to. But benchmarking, as per CPM method, you need to follow these principles only. So these are the two different things. I mean, in a transaction where you actually not use cost plus for your billing, you can still use CPM for benchmarking, and vice versa. That where you used CPM for pricing, you still may not apply cost plus markup for determining your benchmarks. Correct?
So now again, how practically this worked in this case was in year 1, because there was internal CPM available, so the gross profit margins earned by A Limited in the services rendered to AE was 41.65%, and the gross margin earned by services rendered to non-AE was 34.2%, and hence the transaction was concluded at arm's length. In year 2 again, the gross profit margins of A Limited on an entity level basis, because the transactions were only to AEs, was considered, and that was around 50%, and that earned by comparable companies. This is just an example of just one company, but considering that the average margins of all comparable companies turned out in the same range of 30 to 35%, the transactions were still at arm's length. Now again, I've here tried to give a screenshot of what from Progress if you were to calculate the gross margins. Again, not very reliable, but if you were really left with no other option, what you could consider is, for the income side, you could again consider the sales, which will be really the income from services. And on the cost side, what you could consider is the compensation to employees being a direct cost, and if there are any outsourced professional jobs, again that could be considered as a direct cost, and you could calculate the gross margins accordingly.
Now when you take compensation to employees, would that not include compensation paid to the directors, to the accounts, to the HR, to the finance team? So it's not always very easy to get the actual direct costs, but then you use certain assumptions that when I'm doing benchmarking of comparables, even for them I'm picking up the entire employee costs, and majority of these costs are direct costs. They have huge labor force which goes into production. So I'm putting 1, 2, 3, 4 assumptions. If any of my assumptions does not hold good, my comparability will go for a toss.
So we'll move on to case laws for CPM right now. So the first case law is Tara Ultimo, which was again discussed earlier. I'll deal it in more detail right now. The taxpayer is engaged in manufacture and export of diamond and gold jewelry. During the year, the taxpayer purchased diamonds and also sold diamonds and jewelry to its heirs. So while for the purchase and sale of diamonds per se, the taxpayer adopted cup method, and for computing the ALP of the jewelry sales which was manufactured by it, it adopted CPM. However, the PLI used by it was gross profit to sales, and wherein the gross margins earned by the by Tara Ultimo on the A transactions was compared with gross margins earned in non-A transactions. So this was a case where internal CPM was used. Now the TPO rejected CPM on the grounds that the taxpayer did not provide detailed calculations of the gross margins as were calculated by Tara Ultimo on each segment, and it also contended that the nature of transactions with A's are functionally different. So what it said was, in the A transaction the kind of jewelry you sold to the A's, and in the non-A transaction again the kind of jewelry sold to the non-A's are really different, and hence you really cannot compare the two segments. And also that the taxpayer had adopted GP to sales as the PLI, which was incorrect. Further, the TPO also rejected the cup method for the purchase and the sales of diamonds, and he went on to apply T9 on the entity level. Now the issues for consideration in this case was, can CPM be adopted as the most appropriate method, and second one is, can CPM be applied by comparing the average gross margins earned from A transactions and comparing it with the gross margins earned from non-A transactions. And third, and the most important I feel, is, can gross profit on sales be adopted as PLI or by application of CPM for benchmarking the transactions. So ITAT, while rejecting CPM, observed that, and this was the main reason for rejection of CPM, was that the most important unit for manufacture of those jewelry was diamond. which was purchased at a price for which the taxpayer could not determine the ALP, because the cup method was rejected because the taxpayer could not really produce enough documentation to establish that the import is at arm's length under the cup method. And because these imports had been taken into consideration for calculation of costs, for calculating gross margins, and because ALP is not available, CPM cannot be applied in this case. Further, as regards comparability to the two segments, the ITAD observed that no efforts were made by the taxpayer to show that the terms of sales to A's and non-A's and all other relevant factors are similar in either of the segments. So again, internal CPM was really not applicable in this case. Now, thirdly, regarding the approach of determining of ALP, so while the ITAD observed that for calculating the gross margins in transactions with unrelated parties, you could club all the transactions of unrelated parties, but for really applying it to your A transactions, you have to do it by transaction on a transaction by transaction basis and not on a global basis, meaning that the two approaches we discussed earlier. In this case, basically what the ITAD is saying that you really cannot just compare the gross margins. You have to identify the direct and indirect costs incurred for the A transactions and apply that gross margin on for non-A transactions to those costs, and then determine the ALP, and not just merely compare the gross profit margins. And lastly, what CPM, it held that the CPM was incorrectly applied by taking GP upon sales. Now CPM is a cost plus method, so ideally your denominator has to be the cost and not the sales. So thereby it held that the taxpayer also erred in incorrectly applying the CPM method. And lastly, because there was no documentation to support direct methods of cup in case of import and sale transactions and CPM for the jewelry transactions, the direct methods were rejected, and ultimately it held that indirect methods like TNM or PSM could be observed, and this matter was remanded back to the TPO. Any questions on this? Go to the next case law. So this is a case of Almuca India Extrusion Limited by Hyderabad ITAT. So in this case, the taxpayer is engaged in the manufacture of aluminium products. During the year under consideration, the taxpayer made export sales to its A's and domestic sales to its non-A's. When the taxpayer adopted internal CPM to benchmark its international transactions, the TPO rejected internal CPM, alleging that the allocation of cost to the A and non-A segments was incorrect, and thereby, because no other method was available, it adopted external TPM and made transfer pricing adjustments. So the real question in this case law is whether you could use internal domestic transactions for benchmarking the international transactions. The ITAT held that domestic transactions can be used for benchmarking international transactions as a product sold in either of the segments or similar. So as such, there was no major difference in the two segments. And it also held that the TPO's rejection of internal CPM by merely contending that the allocation of cost was incorrect was also not appropriate. The TPO has to record and substantiate why the method selected by the taxpayer is not correct and why some other method should be adopted, which was not done by the TPO.
In fact, just one point over here. While the TPO just mentioned or rejected in one line, saying that indirect costs have not been allocated appropriately, I think what he could have done is looked at various other differences between the two transactions. Let's say, for example, in case of a local transaction, the cost to customer is different, probably because there may be some indirect taxes added on to it. Whereas in case of international transactions, probably there were no indirect taxes added on. In case of, let's say for example, physical exports, probably there are some incentives which are available in terms of, DEPB or some licenses or those things. So those also go on to determine or to reduce your costs and thus show that you earn better margin. But these are all arguments which could have actually gone in favor of the assessee, and that is the reason probably the TPO may have done this analysis but may not have discuss. But these are various factors. I mean, geographies are different. If you could have analyzed the economies of the country where this was sold with the Indian economy, probably that would have also said that prices determined in that market cannot be used as comparable for this market. There are various things, but so I think this case was also remanded back to the
Not sure.
One more point, even adjustments are warranted, right? Because the domestic and international comparison that you're making. Forex, as you said, indirect taxes and all. That's also something that needs to be looked at.
So the third case law is Frigoglass India Private Limited. Now Frigoglass is engaged in manufacturing and trading of some glass door merchandising used in the alcoholic and non-alcoholic beverages industry. And then the taxpayer entered into various international transactions with its aides, including that of sale of finished goods, sale of components, purchase of raw materials, purchase of finished goods for resale, etc. Now the taxpayer benchmark its transactions in the manufacturing segment using CPM and that in the trading segment using RPM. Again, TPO rejected both of these methods and without really giving any material reasons, and it proceeded to apply entity level TNM to benchmark the transactions. Okay, the reason for rejecting CPM for the manufacturing segment was on account of the following: that the taxpayer's functions were interlinked and the cost base of the taxpayer did not include direct costs. Again, determination of cost was uncertain and extensive information about the cost base of comparables was not available. And again, as the general problem in the industry is that there is no clear guidance available on the accounting treatment of the direct costs and how you really calculate the gross margins. And again, there is no discernible link between the level of cost and market prices compensation model. So what the TPO try to say is that your ultimate pricing may not really be dependent as a markup on the cost, and that is why CPM should not be selected. And says that where reliable method like TNM is available, there is no need to go to CPM because CPM has these challenges of identification of direct costs and calculation of gross margins. Now the ITAT rejected the TPO's approach without really providing any material reasons. It observed that except for making some assumptions and general observations, TPO did not give any objective findings to reasonably conclude that CPM was the most appropriate method for the manufacturing segment. And that is why the ITAT observed that each transaction really needs to be benchmarked separately, and for a manufacturing activity CPM is the most appropriate method, and similarly for RPM, for the trading segment RPM is the most appropriate method. So the TPOs really should have given very strong reasons for rejecting either of these direct methods for applying TNM.
Friends, you are covering profit split method.
So what we will do is, if we are done with one method, let's have 5 minutes where you have questions. Please ask. You have some situations that you have come across. Please share so that others get out of that.
The last video, the last case one we just did, rejecting the TNM and sticking what's your view?
I mean, pardon me, but I would agree to all the ITT decisions, even if they are contrary. I am no one to give a view.
No, it is generally. I felt it was correct for the TPO did. It is interlinked.
I think we need to look at the exact, complete details of the situation, and when the ITT has come to this decision, probably there is some science, some logic, some information that has been there with them. So, if I were to disagree, I would disagree only after looking at the case in complete details.
And really, the taxpayer had really two separate segments. So even if you see the purchase transactions, so the transactions where it was purchasing finished goods for resale, that was a separate transaction which was considered as a trading segment. While the purchase of raw materials or components was clubbed in the manufacturing activity. So again, there were really two separate segments.
No, but you're buying and you're selling to the same age, right? As to the diagram, the first slide.
No, so the purchases of because this is a CPM method, so the purchase of the raw material and sales is of those components and spares, and not really for the trading segment.
So is it the same A, is it different A's in the future?
That I'm not very sure of. Yeah.
That probably makes a difference, yeah. Correct.
So, I think any questions on how do you practically apply CPM? Let's do some small revision. So I think if somebody doesn't volunteer, I'll probably have to compel somebody to answer. Please. You want to try?
I don't know, there still is a doubt in the mind that
So that is why this time that you can ask more questions.
I don't know how relevant would my question be. But suppose I am a full-fledged manufacturer taking all the risks of the business. Still can I apply CPM? Or CPM can be applied only when I have limited risks and limited functions that I perform that time?
So in fact, you have to look at what are you, you are a manufacturer, what is the international transaction that you are benchmarking? Are you benchmarking your purchases or are you benchmarking your sales?
So first let's take purchases and then we take sales again.
Okay. So in case of purchase transaction, where you purchase say component for manufacturer, you are a manufacturing company, so you probably purchase a raw material from group concern or associated enterprise, and then onwards do a manufacturing and sell it to a third party. Now in this situation, can CPM be applied? Okay. Again we go through the stages of examining. Which is the party which has simplest of functions, assets and risks? Of course the A, right, from which whom you are purchasing raw material, because you are doing a complex function of manufacturing, right? So in this case, when you look at A as a comparable, whose cost do you look at to determine the gross profits? So does A do something whereby he can have a gross profit, or does he do some significant activity? He is only purchasing and selling. So in A's case, can you apply or use cost plus? In certain situations, yes, but most of the time if it is a pure a simple trading activity, would you still look at a cost plus?
No, I think what the primary is after a FAR you really determine the tested party, and then based on that you determine which is the most appropriate method.
Let's say in a situation where we determined that based on FAR, the AE from whom we are purchasing is the tested party.
Correct.
So what is the next step now?
So you see the nature of the AE, basically it's whether it is into trading or manufacturing. So if it is just into trading, then ideally you maybe look at cup if cup is available, or you go to RPM, because that will be the next most appropriate method I think after cup, if cup is not available.
Umesh, will we look at RPM when we are benchmarking the profits of the AE?
Under RPM, yes, right, because AE is a tested party, so what you'll see is for that AE, which is for testing the AE, what is the most appropriate method, and because it is a trader, I think for a trader RPM would be the most appropriate method. If RPM could be reliably applied, again depending on whether data is available for comparables or...
Does everyone agree, disagree?
Sorry, but under RPM you have to buy it from an A and sell it to a third party. You are selling it to an A.
Sorry.
Yeah, so RPM cannot be
RPM.
See, you jump to the TNM line.
Correct. Sorry. Yeah.
So in this case, again what you do is you go on to TNMM, where you benchmark the profits of the A in purchase transaction. This was similar to the first case study that you took, where there was a purchase from A and then sales to A.
Correct.
So how did the...
in that case, the A was also a manufacturer of those components.
Okay. So now let's look at the sale transaction, that where you purchase from an unrelated party and you manufacture and then you sell it to a related party. In such case, can CPM be applied? Absolutely. Yes. It could be applied. Provided definitely that your benchmarking is possible. Again, I'm coming back to the basic question. How do you apply CPM? What do you do? I mean, let's take this situation. Now CPM we've determined to be the most appropriate method. So how do you now do the benchmarking? What will you do? Step 1, step 2, step 3? Is everybody clear on how do we do CPM benchmarking? Sorry?
Cost segregation.
Yes. So what are the various steps that we need to do? Simple steps.
Aggregate the cost, allocate the cost, and you determine our GP margin.
Correct.
And you determine what your sales price. That would be the very easy. Now that will compare cost type. Second step would be you must your transactions with the comparables. You identify the cost of the comparables, what are their GPs, and then calculate their selling price. Okay. Now this comparison of second step. Compare cost type the selling price of your selling price of
I think slight modification to what he said. What I would do is first compute my costs, then I would find out what is the gross margin of comparables. Correct me if I'm wrong, Umesh. So gross margin of comparables, that is the normal gross profit margin that I would add to my cost to determine what should be my ALP, then compare it with my actual sales price. Correct? That's the approach. So step 1, determine costs, direct costs. Step 2, determine GP of comparables. Average it out. You take that as your normal GP margin. Step 3, determine arm's length price by adding that gross margin or adding that gross margin to the costs. The ALP is then to be compared. Step 4. So these are the basic 4 steps. Now there could be various modifications in each step or further detail, cost segregation, cost allocation. So these complexities could increase at each stage. While you determine your gross profit, what costs do you look at, whether a cost is a direct cost or an indirect cost, whether this is an extraordinary cost or a routine cost. So these are the simple steps that we look at while we determine. When we even do comparability, ALP to everything, what is it that you would look at when you do comparison? Would you look at pure price? Terms of transaction. Do terms of transaction have effect on prices?
Yeah.
So if now how do you apply it in cost plus is a real challenge. I have no answer for that, but because you are applying gross profits of comparables, you don't know what terms those gross profits were earned in. Unless it's your internal comparable, you would not know. So in case of internal comparables, I would even look at doing adjustment for terms. Say if credit terms to AE is 60 days, non-AE is 30 days. So all those things. So at each step there could be various complexities, but these are 4 basic steps that you do to do CPM.
Warranty also is, warranties.
Yeah, various things, warranties. So should we look at profit split now, or we want to deliberate more on cost plus method? I don't want everybody to look at the watch, even if you don't complete. I think we may spill over if that is required, probably because next method we have is TNML, where we have one full session for that. So we can actually do a spillover if everybody feels that we need to spend more time on CPM. Because we don't come across CPM cases very often, so it is necessary that we debate, discuss.
That will be, I think, much better rather than just, because these people can really, rather than, discussion will be far more beneficial.
So I think in PSM also, Deven, what I suggest is let's not read through the slides. let's discuss the gist of the slides. People can read through the slides at their own time when they have.
Okay.
So let's discuss. What I would suggest is, rather than you reading the slides, discuss the gist. What have you discussed in those slides? And in fact, I would want it to be more interactive rather than you all listening. I want you all to ask questions and let the speakers do the answering. That will also test how good they are prepared.
This method actually is contribution analysis that from the combined profits on control transactions which are allocated with the associated enterprises.
You also come up with specific.
Yeah.
I'll put my questions also.
External market data might reflect how independent enterprises allocate profits to similar circumstances. The relative value of the contributions can be calculated directly. The actual value can be determined. Value of the contribution can be determined. The determination will not be required. Actually, so we determine the operating profits.
So what is profit split method?
Splitting the profit and transaction between the companies that were involved in this transaction from start to finish.
Correct. So profit split is you aggregate both all the transactions from start to end, determine what is the profit, and split the profit based on the FAR analysis. And then you compare with what you have earned to what the comparable earn. Is the simple profit split method. Correct?
You have to first ascertain divide gross profits first and then subtract expenses. That is to arrive at NP.
Correct.
The bottom points are the PCM is the when most of the organizations produce significant intangible property. They are not talking about engineering, they are talking of intangibles. Just to realize we do it in joint venture. For side Jiga, is 27 might effect.
Correct. In fact, all your accounting standards will also impact.
Yeah. This will effect on profits of special conditions made or imposed in a controlled transaction. But determining usual profits independent enterprises who are expected to realize for engaging in transactions.
Can we look at simply answering a few questions, basic questions first, and then look at the details. Number one, we understood what is profit split, splitting the profits between the entities involved in the transaction. Number two, under what situations is the profit split method recommended? What kind of situations do we really do a profit split? Why would a profit split be better in those situations? Umesh, you want to share some?
I think generally profit split method is applied when the transaction really has unique intangibles. So wherein all the entities within the group deploy some intangibles for which really you cannot determine the returns or the profits to be allocated to each entity, and that is why you first calculate the entire profit earned on the entire transaction and then allocate or then split the profits either in the ratio in which really each respective entity performs the functions and deploys the assets.
in simpler words, a situation or a transaction where where the intangibles are involved, or where the situation is such that the profit can easily be shifted across from here or there. So that is why you look at profitability in aggregate, and then you do a FAR analysis to determine what should be share of profit of each of the entity. So typically what happens in a situation where there are huge use of intangibles, or where the transactions are dependent on intangibles, who owns the intangibles? Who's using the intangibles? How intermingled is the use and the ownership? Is the ownership split? Who's the economic owner of the intangibles? Who's the legal owner? So there are various questions that come up where finding out profitability of just one entity, ignoring the functions, assets, risks and intangibles of the other entity is not feasible, or would not give you the greatest or the best of the results. You would need to add it up and look at it together. Only then you will come to know what is the correct or appropriate profitability. In such situations, profit split is mandated. What was one of the recent circulars that were issued that mandated use of profit split method? Can anyone share? It was contract R&D. There was a specific circular that was issued by CBDT that in case of contract R&D they promoted use of profit split method. What happens in a contract R&D situation? Now this is something which I believe it's not law, it's practical, so I want answers to come from you guys. And trust me, here nobody would hold anybody responsible if you say anything wrong. So please feel free. This is for everybody's learning. And even if it is, you think that it is a small question, it may clarify everyone's doubts. So please do ask questions and do feel free to give your thoughts. And if you don't give, then as I said, I'll pick somebody and make them speak. So then there is no way out. And I can randomly pick up anybody.
I think Kinjal was saying something.
Yeah, Kinjal, sorry.
In addition to what both of you said, rightly said, another situation where we use PSF is apart from the intangibility involvement, there's the transactions that are interlinked also, right? Because that also mandates the use of PSF.
Also, it's sharing activities, financial services also. Sharing activities, financial services, and global sharing especially.
Correct. So I think that also boils down to where services are or the transactions are interlinked or there is use of intangibles. But mostly I have seen in financial services, TNMM is more broadly used.
Telecom sector, they have a very complex structure of transactions. I was called from Mumbai to US now. It's very simple that I can dial and I can work with some people. But actually it's very complex. It's like that. Actually we have one client like that. It is like, it operates like that. If I want to call from now to US, there is a local network, a say Airtel or Vodafone. It becomes a call from myself and it's to Indian border, that is help. Then there is some another network which will take that call further from here to New York. And then again from New York territory to New York, that branch to you are calling them again that US local network on New York. And the billing will actually comes to me because I had made the call. So I have to pay to Airtel. How this revenue will be approved as split between the different entities. Actually where the BSM.
Correct. Very good example. Umesh, you want to share how it works in contract R&D industry?
I think in contract R&D, really the controversy was because when you're doing research and development, really if some intangible is generated out of such research and development, so ideally the Indian entity should be compensated for the returns based for that intangible. But what happens is these contract R&D centers are generally remunerated on a cost plus basis. So what the department contends is that really adequate returns are not attributed to India, and thereby there is an erosion of the tax base in India. That is why I think the department earlier had prescribed PCM. I think after that they withdrew the circular based on the Rangachari committee report which was made public later on.
So in contract R&D, typically what happens is you are a R&D unit where you do research and development over here in India. You develop intangibles and those are actually owned by the company overseas. So any future benefit in terms of royalty or exploitation or on sale accrues to them. So what is India getting out of this? The Indian R&D cost plus a markup of 15%, 20%, 25%, 30%. So the revenue is saying, when you are doing such a key function over here, of the profitability of which will accrue over probably generations, then why don't you look at profitability in the overall situation right from initiation or development of R&D to the exploitation of R&D, and you do a profit split. Now what are counter arguments to that? Will India subscribe to the losses that happen later? Let's say a technology was developed, but it could not be commercially sustained. So would India say that, okay, no, your R&D loss is completely lost, I allow you that cost or loss to be set off against future profits? So there are these arguments that are there both ways, and as he rightly said, even the Rangachari committee report was against use of PSM for several reasons. Again, in PSM the challenge is how finely can you define or differentiate the F, A and R. When you say the functions are so interrelated or the risks are so interrelated, can you really specify and put a basket into A and B? All the time the answer is not necessarily yes. Again, benchmarking is a huge challenge. Would you find a comparable who's doing exactly the same FAR and E as you? Probably you will find a lot of comparables at the totality level. But your FAR may not be identical as that of the comparable entity. But at totality level, both of you provide the same things. So there are pros and cons of both, profit split method. But I think
all the R&Ds are not same.
Absolutely.
You have seen the cases where there is some basic R&D which is then you have to go on corporate. Then you are doing for some small customer or something that you are doing R&D. Something which is very specialized R&D which creates a new product or creates a new technology. That is what this setup. All contract R&D will not go for a profit split.
No, absolutely right. The extent
which is done here and what is the application actually of that R&D?
Absolutely. So, in fact, that's what even one of the points in Rangachari committee report was that you specify and mention which R&D activity. In fact, the report also said that R&D activity. The circular also said that on specific R&D activity, right? I'm not carrying a copy of the circular. Not all R&D. But yes, your point is right that R&D, which is a simple development activity, or say you are doing a clinical research over here, how much does a clinical research really contribute to development of a drug or maybe exploitation at a later date? It is only clinical validation of a drug. How much does that contribute? Now, if the drug is to do with a cancer drug, I would say probably huge. But if it's a common cough and cold drug, do you say there is a huge value addition done through clinical research? Maybe, maybe not. So you really look at a situation in each case and look at how significant IP is and how does it really determine the pricing. I think we'll go to it if you can give me and you can continue your presentation.
In this method, you have to only ascertain the combined net profit of the AE from international transaction, then split or distribute allocate this NP to all the AEs involved with the respective contributions to earning that profit. This allocation will not be done solely for tax motivated users. It should not be distorted, it should be pure. Then this apportionment, profit apportionment is used to ALP. According to OECD, the underlying purpose of the matter is to determine what division of profit independent enterprises expect in relation to relevant transactions. This will split on economical value basis. This is the functions, there is a FAR analysis or this is a FAR analysis. It identifies the aggregate net profit combined or split for the associated enterprises economical value basis. Approximates the division of profits that will remain ALP between independent enterprises. Two approaches are alternative approaches to PSM. One single scope allocation method and two stages would be the allocation method.
So the circular, there were two circulars that came in. One circular determined the conditions or laid down the conditions in which case you would say that a unit was a significant R&D unit, and second said that use PSM for determining arm's length price. So if there were, I think, 5 or 6 conditions or tests to determine, if you can just read them out for everybody's benefit.
So the first condition is that the foreign principal who is actually engaged this Indian company for doing the contract R&D, that foreign principal performs most of the economically significant functions for that research and development, whereas the Indian Development Center would really be involved in.
So the controversy here that they were trying to address is that everybody was taking a cue that I am an insignificant research and development part, so I should be applying cost plus method and not PSM. So, and department was always trying to apply PSM. So then the controversy really was who is insignificant entity or taking insignificant risks and those things. So that is why these 5 or 6 tests were prescribed. Now I think in light of that we should read this.
Yeah, so the first was again the foreign principal performs the most significant functions. It provides the funds and capital for conducting this research and development, and it deploys the most economically significant assets. And that the Indian Development Center works under the direct supervision of the foreign principal, who not only has the ability to supervise but actually supervises these contract R&D activities undertaken in India. And again, so this was functions assets, and again the Indian Development Center does not really assume many material risks in respect of such activities. So if all these conditions are satisfied, then you could say that really the Indian company is not bearing or performing any significant functions and bearing any significant risk. So in that case, the Development Center could be classified as an insignificant contract R&D service provider.
Which factors are very similar to safe harbor, except factor for the definition of
Is this?
That is borrowed from this one. So are we all clear under which circumstances for which transactions should we apply profit split? I think even if you want to take this slide, approaches to PSM.
Approaches to PSM. There are two approaches: total profit split, distributed profit splits. Total profit split steps involve as follows. Determine the combined net profit of the EEs arising from the international transactions with the engaged. Such profits represent the profit earned from third parties due to the combined efforts of both the EEs. We need to note that the combined net profit does not lead to aggregation of entire profits earned by the enterprise. For example, even on profits on certain transactions, there is no contribution by E2 and vice versa. Such profits do not enter into the determination of combined net profit. Only those profits that earned from the joint efforts of the E1 and E2 should be taken as combined net profit. Relative contribution made by each entity in one transaction based on finances, reliable external market data. The split the combined net profit with proportion relative contribution determined as above. Profit so a portion is taken by the LP in relation to international transaction. Profit so a portion is when related to cost incurred by relation to international transaction result in ELP. Same is therefore received profit split method.
So what is the difference between the two?
We go to actually not aggregate, but you have to take this combined profits of well, it is not aggregation, but prepare the combined profit in a second. Then you have to make a relative contribution. You have to see which is making relative contribution.
I think there is a difference, or there are two approaches to determine profitability. One is the total profit split approach, which I think Deven has explained, that where you look at the combined profits of both the entities and then split it on the basis of
relative contribution.
What is residual profit split method?
Under the total profit split, is the total profit from the raw material to the final sale for all the A's in between is 100, say INR 100 rupees. Then we divide the full 100 rupees into each A depending on the part. The full 100 is distributed over the part, that is a total profit approach. Under a residual profit approach, what you do is the 100 rupees is first given out. Only the normal profit is actually distributed depending on the part. The normal profit is say 60 rupees. Because the 40 rupees is kept on the side for now. The 60 rupees is what is divided across, and the 40, which is a supernormal profit because of the intangible, is actually appropriated to the owner of the intangible for the group.
Just to put it a little differently, what we understand by residual. Residual means remainder. So all the entities who carry out simpler FAR, you distribute their profits to them, and whatever is the residual profit, that is with the main entity. So that is the residual profit approach, where somebody who is doing insignificant functions, you have to remunerate him first, and then whatever is residual, it may be more or it may be less, is for the main entity. That is the residual profit. Now both may probably result, at times result into different situation or different profitability. Let's say, for example, there is a super blockbuster product in case of a pharma industry, where there is this drug which is making huge profits across. I mean, the drug cost is minimal, but the sales that it generates is huge. So these are called blockbuster products, or they sell very well. Now, in that case, what is the contribution of a distributor or of a small manufacturer and the IP owner? So the IP is owned by, say, a Swiss entity, and the manufacturing entity is in, say, India, and the distribution entity is in, say, countries like Bangladesh or Thailand or Sri Lanka or the neighboring countries. Now, in this case, you would need to look at start to end, from procurement, from R&D to actual sales. What is the profitability? And then you say, okay, profit to Sri Lankan entity or Bangladesh entity is X. Remove that profitability from our total profits. Profit to the Indian entity, which is only a manufacturing entity, is Y. Remove that from the total profit. Now whatever is the balance profit goes to the Swiss entity. Whereas if we do a total profit split approach, what will happen is, okay, bring all the profits together. Now based on FAR weights, allocate everything. Maybe they may result into same things if the appropriate weight has been given to intangibles. But if that is not done, then probably you look at functions which are more legible or which are more easy to determine or are easily available from your financials. In that case, probably you would equitably distribute amongst these entities. Or let's take a situation where the product was developed in year X and its exploitation is now starting in X plus 3. So where Indian entity is manufacturer and the Bangladesh entity seller, where does Swiss company come into between? Nowhere. Would a total profit approach work in this situation then? because from procurement or production to sales, R&D is not happening this year. R&D is something which has already incurred. In such case, probably total profit may not work. So we have to look at all these permutations and combinations.
Just have a point that even though R&D might not be carried out in this year, but Swiss entity is still the owner of that intangible.
Correct.
So even in this year, there should be some allocation of returns to that entity.
Absolutely. In fact, let's take an example where a royalty is being paid. So Swiss entity is being remunerated for its IP. So even in such case, there may be further attribution to the intangible that may happen. So that is why total profit split approach may not be appropriate, and you may need to go to a residual profit. Although you can look at the total condition and say, like Indian entity contributes to manufacturing the tangible assets, same way the Swiss entity contributes to IP or the intangible asset, and you look at that together and then you find out profits.
I think the stage of the life cycle of the intangible also plays an important role in deciding the approach on the case.
So that life cycle again also differs from industry to industry, from product to product. Like say for example, what is the life cycle of a cell phone? So the engineering part or the development part is constantly on. So the life of a product is not necessarily the life cycle of a brand. BlackBerry, everybody has a live example. It started as a premium product, then it became a common product, and now it is almost dead. So what is the life cycle of the brand? So these are various things that do definitely play a role, and that is why intangibles, whenever it comes into play, it becomes a complex game to determine the correct profits.
Allocate the profit based on to the extent the comparables are available. Further means the example I have given. Now, suppose in the telecom sector I want to apply PSN and RPSN. So what does they say? Airtel earns 10%, Vodafone earns 10%. When you allocate 10% of the money to India, if some other countries involved, they are earning 12%. Normally, they are local India.
Next slide I'm skipping because this is early. These I'm just
correct. And the balance is with the intangibles.
The balance again should be divided based on the FAR.
They should be divided equally? No, not necessarily. With the contribution, net contribution.
Actually, there is no specific guidelines also how the parts should be properly documented.
Should we finish? Let us move to next.
I think now we look at the case studies and the case laws. Should we? Yeah.
One note case.
I think is everybody okay to sit till 8:30 or should we discuss before that?
I think so we'll carry it forward for the next. Could be better.
Take it to the next session. Sure.
When is the next? Is there a date?
So I think that's what we need to discuss and finalize right away so that everybody is aware, because I think next month would be September and everybody would be busy with their tax audits. Earlier the better for everyone, I guess.
Okay.
So
This time
we say
also
the
will be
first
It will depend upon the availability of the hall and everything we'll have to consider.
yeah, definitely. So we'll just propose the first week of August, first week of September.
Yeah, that will be fine.
So I think the chamber will confirm based on the availability of sticker and dates.
But we also want to select a new topic. PSN. Another 2 hours.
Yeah, so we will speak with the TNMM speaker that is already known. Somebody was already.
So we can involve him also. So
Yeah.
we can do.
Finish? Start.
Propose the voter.
So I think let's thank both Deven and Umesh. They've done really hard work and then compiled these slides and let's promise that next time we will ask more questions to them. With this, let's carry out.
No, but just to thank Jigar also to hold the position of mentor. And I will be, I think, glad because every time I'm attending the meeting, but this is the first meeting where I'm not seeing the watch only, I'm seeing the contents of that. Thank you very much.
He made very simple.
Yeah, because.
So I think let's further support them by asking more questions. They will be also glad that somebody is taking interest in their presentation. Thank you. Thank you. Thank you.
Thanks to the chair. This is my first meeting at Internet. My career actually. I'm not from that field, but it's good.
Yeah. I'm supposed to be very interested.
No, I will buy this book also.